the next chapter we would be doing is inventories. Now under inventory there are multiple things you need to understand. There is an accounting standard on inventory. Now the definition of inventory is given under an accounting standard too. Now whenever an accounting standard defines something, we cannot question on it. If you have to question, you'll have to start changing your accounting standard, which you have a right after you become a charter member. Right now, let's just try understanding what do you mean by inventory. How do we value an inventory? Then there is something called as stock taking. These are the three kind of questions what you get. First one, what do you mean by an inventory? How are you going to value an inventory? How are you going to disclose it in the books of accounts? And the last part is what do you mean by inventory stock taking? The confusion generally for a student is the stock taking. Just try understanding the logic on how it works, right? Now let's start first with what do you mean by an inventory? Inventory as a definition means my stock. What does inventory mean? Now what stock are we talking of? Okay. Now when I say a concept of inventory, in a layman term, inventory has four things. First one is raw material. First one is what? Then finished goods. Then WIP. Last one, supplies and consumables. This is a general definition. Now in the exam, you don't have to remember the entire thing. You need to just remember what do you mean by an inventory. Inventory means what? Raw materials, then finished goods, then work in progress, then supplies and consumables. Are you clear with it? Now this is the definition given by the accounting standard. Now let me try understanding what I have given it to you guys with the definition. Inventory can be defined as assets held for sale in the ordinary course of business. What are we talking of? What is the first one we are talking of? Held for the purpose for sale in ordinary course of business. This is my finished goods. So this is my finished goods. In the process of production for such sale, this is my work in progress. Last one, for consumption in production or service, this is my raw material, including maintenance, supplies and consumables. Guys, please remember this, the last part, including maintenance, supplies and consumables other than machinery, spares, servicing equipment and standby equipment. What does this mean? Okay, what is the second part of the definition mean is? Do you have any doubt with till I put the bracket? Do you know what you mean by finished goods? We have already covered in the chapter 1. Do you know what is work in progress? Raw materials which has gone into production but not completed. You know what is raw materials also. Maintenance and supplies other than machinery, spares. What do you mean by machinery, spares? See, there are certain screws and other things which can be used only for specific machines. You cannot use it for all the machines or anything. You can only use it for specific machines. Those do not fall under inventory. If I am saying screws which can be used universally, these are my consumables. But if they mean only for specific kind of equipments, they are outside the purview of my inventory chapter. Are you clear? You need to remember this definition as it is because it's been given by the standards. Done writing down? It's there in your study mat first definition itself. Done till here? The second part is why inventory valuation is important. Why is inventory valuation? This is my second topic. Now, since I've not done financial statements, I'm just trying to tell you guys about the. How many of you guys here know trading and P&L account? Okay. Now, I'm just trying to draw a format of trading and P&L account. How does it look? Opening stock. Let's say opening stock was 1000. Then purchases, I'll write 10,000. Sales, let me write 25,000. Closing stock, let me write 3,000. Done? What do you mean? How do I find my gross profit? Add up the credit, 28,000 minus 11,000. So I have a gross profit of how much? 28 minus 11. Are you fine? Now we define COGS. What is COGS? Is cost of goods sold as opening inventory plus purchases plus direct expenses minus closing inventory. In this question, I don't have any direct expenses, but how do you define cost of goods sold? Opening stock plus purchases plus direct expenses minus closing inventory. What is my opening stock in this question? 1000. I'll just add a direct expense of 3000 just to make it more easier. Purchases is what? 10,000. Direct expense is what? 3000 minus closing stock of 3000. Therefore, my cost of goods sold is what? 11,000. Yes or no? Gross profit is actually calculated by sales minus COGS. How do you calculate gross profit? Sales minus COGS. How much was my sales value? 25. Cost of goods sold was what? 11,000. Therefore, my gross profit was 14,000. Same thing is what I'm doing in my trading account. Is everyone clear till here? Nothing new I'm teaching, right? Now, the first reason why valuation of inventory becomes important is because my determination of profit is heavily dependent on my inventory valuation. So write down the first one. First importance is determination of income, determination of income, valuation of inventory. Valuation of inventory is necessary for determining the income. So write down COGS is equal to what do you mean by COGS? Cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock. Write down next line. Gross profit is equal to sales minus COGS. Till here, are you fine? Write down the next line. Impact of inventory valuation on profit. Impact of inventory valuation on profits. Guys, everyone, I want you to look into this. What do you mean by overvaluation? What do you mean by overvaluation? Let's say my value is 10,000. If I show any value more than 10,000, we call it as overvaluation. Undervaluation is what? Anything less than 10,000. Now, what are we going to be doing right now is I'm trying to understand how my inventory valuation will have a change or an effect on a profit. Let me start with closing stock. Now, in my closing stock, instead of 3,000, let's say I valued it at 4,000. Instead of 3,000, I valued my inventory as what? 4,000. That is my closing stock. What will happen? This became 4,000. What will happen to my profit? My profit will, so my total becomes 29,000 and my profit from the 14,000 becomes 15,000. That means if my closing stock is overvalued, my profit will also become overstated. Are you clear? So write on the first one. Overstated statement, if the closing stock is overstated, the net income also gets overstated. Did you understand this? So closing stock goes up, guys. You have to remember this. This is part of your, it is going to help you guys later when you come into decision making and all. If this closing stock goes up, what will happen to your gross profit? Gross profit will go up. Let's say closing stock, instead of 4,000, it was 2,000. Instead of 4,000, or what was 3,000 earlier, I took it as 2,000. What will happen to your profits? Huh? My profit will also reduce if my closing stock goes down. So clear? So write down. Understatement of closing stock will lead to, next case, which is the other stock I have? I have one side is the closing stock, other side is the opening stock. So I'll bring back all the stocks to the original value. Now I want you guys to understand, if my opening stock, instead of 1,000, I write it as 2,000. Is it overstatement of opening stock? Yes. What will be the effect on profit? So what will happen? See, at the end of the day, your objective is to balance this with this. This total is what? 28,000. The moment instead of 1,000 you take it as 2, what will be your gross profit, which is the balancing figure? $28 minus 2, 26 minus 10, 16 minus 3, 13,000. Originally my profit was what? 14. Once my opening stock went up, what happened to my profit? Profit went down. Are you clear? So write down. Opening inventory, overstated. Opening inventory overstated. Profit will be what? Understated or overstated? Understated. Last one. Opening inventory understated. Opening inventory understated. Opening inventory understated. Profit will be what? Overstated. Are you clear? Whatever we have studied. So the first reason why we do inventory valuation is what? For determining the income. So I told you about COGS. Anyone, any doubt with COGS? How do we find gross profit? Effect of overvaluation of stock on the gross profit. If opening stock gets overvalued, gross profit gets undervalued. If closing stock gets overvalued, gross profit also gets overstated. Are you clear? The second part of it is, since we have not done the financial accounting, financial statements, you need to understand the second part is, when we are trying to find financial position of a business, when we have to try finding what? Financial position of a business, one of our important category of current assets is inventories. One of the important aspect of current assets is what? Inventories. If inventories are overvalued or undervalued, if inventories are what? Overvalued or undervalued, we say balance sheet does not show its true position. So we always want the inventories to show the true position, and inventories being one of the major component of current assets, we want to value it to ascertain the true financial position. Are you clear? So what's the second reason of valuing inventory? Financial position. The third one, what we call is liquidity analysis. Have you heard this term liquidity? What do you mean by liquidity? Liquidity analysis. Have you heard liquid ratios? Heard any time earlier? What do you mean by liquid ratio? Liquid ratio is basically current assets minus current liability, or we call it as working capital ratio. Okay. Why are you buying stock? To sell. If your stock is getting, if your money is getting stuck in the inventory, then isn't it a wrong position to be in? Why are you buying goods? To make sure you sell. If your money, what you have paid towards the raw materials, is stuck with your inventory, then you cannot always predict that, hey, you know what, let's say for an example, you have purchased 1 dozen of onions today. You immediately want money. If you go and try selling back the onions, would you get the same price? Might get more, might get less. But I'll ask you a simple question here. I have a building. I have 1 packet of pens. I'm a pen dealer. I have what? 1 packet of pen. I have 1 building. Which is easy to sell? Pen. What do you mean by liquidity? Liquidity means availability of cash, or something which I can convert it into cash easily. Current assets are the assets which can be converted into cash easily. And one of a primary component of current assets is my inventory. Inventory helps me to know my working capital requirement. Therefore, valuation of inventory, I want to value it as much as it's real. I don't want it to show me a higher figure, because let's say I tell you know what, this pen what I'm using, because I used it, is worth 1 crore. This pen, because it's my stock, I used it, that's why I'm planning it to be sold for 1 crore. Today I became bankrupt. I'm going and selling, you know what, this pen is worth 1 crore. Is somebody ready to buy? Would there be anyone ready to buy? No, right? Because it's not showing its actual value itself. Rather, I say, you know what, this is worth 10,000. The actual value of the used one is 6,000. And I show it at 6,000 in my books. Don't you think it's a lot more realistic value? So I would always want my liquidity position or my current assets to be showing an actual real figure, because it impacts my liquidity position, and current assets, especially inventory, plays a larger role for it. That's the third reason. Are you clear? The last reason, like I told you, you have no option. Companies Act makes it mandatory. What makes it mandatory? Companies Act makes it what? Mandatory to disclose about valuation of inventories. Are you clear? Done till here? So what are the 4 reasons why we do? First one, determination of income. Second reason, financial position. Third one, fourth one, in the exam you write these 4 headings, and if they ask you, you can write something within. Don't try mugging up all of this, because it comes once in 10 attempts or 15 attempts. So if it comes, I don't want you guys to ignore it. Just write, at least keeping the core points to it. Are you clear till here? Very, very important. Before we go into the next one, I want you guys to tell me about what does Prudence Concept say? Chapter number 1, Unit 2, Prudence Concept or Conservatism Principle. What do they say?
Whichever is lower market value or the cost of
You always, if there are any anticipated losses, you record it, but not the anticipated gains. And we spoke about one of the examples there, that my inventories are valued at cost or net realizable value, whichever is lower. Because of which concept? Conservatism or Prudence Concept. We shall be valuing what? All my inventories at what cost? Cost, or we are changing the term. Till now we were talking about market value. Now I am moving into a concept called as what? Net realizable value, whichever is what? Lower. Done? Now what we will do is, we'll individually go into 2 parts. What do you mean by cost? What do you mean by net realizable value? Are you clear? Now the definition of cost, please understand what do you mean by cost is, there are 3 parts to the cost definition. First one is cost of purchase. Cost of what? Purchase. The second one is cost of conversion. Third one, very, very important, other costs incurred in bringing the inventories to their present location and condition. In layman term, raw materials, cost of converting your raw materials into finished goods and trying to bring it to the place of production, not at the place of sale. It is what? To the place of production. Clear? Now, few things which you need to remember. When I say cost of purchase, what does it include and what does it not include? When I purchase any raw material, certain times raw materials, you would get a trade discount. Let's say, you know already what is a trade discount? I told you trade discount are the discount which is given to everyone. Let's say I'm purchasing goods. Guys, I want you guys to remember this values, whatever I'm trying to say. I purchased a goods for 100 rupees. I purchased a goods for what? 100. I paid a GST or let's say excise duty of 15 rupees. So how much did I pay towards purchase? 115. When I say cost of inventory, is it 100 or 115? Is it 100 or 115? Okay, it's gonna be 100. When I say cost of inventory, it means what? 100. Why? There is a condition you need to check. There is something called as an input credit and an output credit. Okay. If any of the tax I pay is eligible for an input credit, if any of the tax I pay is eligible for what? Input credit, then this tax what I pay is not part of cost. For your exam, only thing you need to remember is any tax where input credit is available. Remember this, any tax where what? Input credit is available shall not be part of cost of inventory. Please write it down.
What is input credit?
I'll explain it to you. First write it down. Because input credit is a CA intermediate portion. So when you learn input credit, I don't want you guys to miss out what input credit is. So first write this down. Any input credit, write down input credit, comma, trade discounts, duty drawbacks are deducted from the cost of purchase. Are deducted from the cost of purchase. Till here fine? No problem whatsoever. Now, what do you mean by input credit? Guys, see here. Let's say I purchased goods for 100. I paid a tax of what? 15. How much was my purchase price? 115. I sold goods for 200. Tax is 30. So I should pay 230 rupees is what I got by selling the goods. Now, how does this tax system work is, this 30 rupees tax, right, I am collecting from the customer. When I sell the goods, so let's say for an example, when you go and buy goods in Big Bazaar or any of the shop, you know, there would be a GST charge, right? That GST, what they do is, the hotel or the shop will collect on behalf of you and then remit to the government. Are you clear? So when let's say the goods is worth 200 rupees, you are paying 30 rupees tax. What is the duty of me is that I have to take that 30 rupees and remit it to the government. Are you clear? When I remit 30 rupees to the government, if look into it, this 15 rupees, when I purchase goods, did I already pay 15 rupees to my supplier? When I purchase goods, did I pay 15 rupees to my supplier like the way my customer is paying me? The supplier, to the supplier, I am his customer, right? I am paying him 15. So I am telling the government, you know what? I know I am to pay you 30 rupees, but I have already paid you 15 rupees in terms of my purchases. I have already paid you how much? 15 rupees in terms of your purchases. Therefore, I will only pay you how much tax? 15 rupees. This way of claiming the tax, what you have earlier paid towards your output tax, we call it as input credit. For you guys, advanced knowledge for foundation, only thing you have to know is whether this 15 rupees can be reduced from your tax amount. If yes, we call it as input credit. If no, then your cost of purchase will be 115. Understood? Did you understand this? So cost of purchase, trade discounts we already have discussed. What do you mean by duty drawbacks? Heard that term? Yeah, ma'am.
Suppose we have paid excise duty or custom duty at customs, then there will be the discount.
So what happens is duty drawbacks, in a layman term I'm trying to explain it to you guys. You would have paid customs duty or to encourage a particular industry, right? What government does is they give back the tax what you have paid, or they give you benefit. That kind of benefit what we give, we call it as duty drawbacks. Whenever you get a duty drawback, that amount also you'll be reducing it. Clear? First one was what? Cost of purchase. Everyone clear with cost of purchase? Cost of purchase is what? The money I paid towards the raw materials, or in case of trading company, the trading goods. I shall exclude what? Trade discount, duty drawbacks, and my input tax credits. Clear with it? Cost of conversion is easy. What do you mean by cost of conversion? Sales. What is cost of conversion? Cost of conversion is basically converting your raw materials into finished goods. This includes labor, direct expenses, and overheads. Overheads means indirect expenses. So what do you mean by cost of conversion? Cost of converting raw materials into finished goods. Done. What is the third condition? We covered purchases, we covered cost of purchase. What is the third category? Other cost incurred in bringing the inventory to the present location and condition. For an example, transportation charges. You might have purchased raw material in Kerala, you want it in Bangalore. The cost of raw materials which you are incurring on transportation from Kerala to Bangalore. And let's say for an example, when you have purchased, let's say you purchased some kind of a unique ice from Kerala. You said, okay, transport it to Bangalore. The moment it came to Bangalore, it was water. Option number 2. You want that ice to come in the same format. That means you might have to incur additional cost. Even that additional cost, what you are incurring, will be part of your inventory cost. So it's not just bringing in, you have to bring it in the condition desired. So what are the three things? What does cost of inventory include? Cost of purchase, guys, remember this: cost of purchase, cost of conversion, and bringing the inventory to the present location and condition. This is important till your CA final exam. Can we go further? Now, market, very, very important. Costs not part of inventories. Costs which are not part of inventories. First one, abnormal wastages. First cost which is not part of inventory is what? Abnormal wastage. Want an example? Okay. Let's say for an example, you remember the petrol vans, tankers which goes in? You know, if you put in 5,000 liters into it, okay, do you think when you bring it to the petrol pump, you'll get 5,000 liters? There are evaporation which is bound to happen. Okay. Now, there is an industry standard given that, you know what happens, let's say, practically think that tanker is there. No, even though you filled 5,000 liters, you cannot transfer the entire thing back to the the petrol pump for multiple reasons. One, because a lot of time, if you see in the water bottle, when you pour in the entire, there will be a lot of water which is surrounded the bottle. You won't get the entire will you tilt the lorry and then fill it up? Not possible, right? And also, while the transportation happens, there is a normal loss which gets incurred. Now, let's say for an example, if you put 100 liters, you will get 5 liters of wastages. So 95 liters is your output. Who is giving you 5 liters is going to be wastage? Is the industry average. Okay. For 100 liters, let's say the cost was 9,500. For 100 liters, the cost was what? 9,500. Now, what was your normal loss? 5, right? Now, generally, if I have to find out the cost per unit, I would have done 9,500 divided by 100, 95 per liter. Yes or no? Now, if it is a normal loss, what happens is this 5 liters will be absorbed by the good units. This 5 liters of loss will be absorbed by what? Good units, which is, now see here, my cost per liter will be 9,500 divided by 95, 100 per liter. So your cost per liter will no longer be called as 95, it will be called as 100 rupees. Are you clear? Because this loss no one can avoid. The guy, whoever is buying it, he has to pay for that loss also. Therefore, your cost went up from 100 to 95. Are you clear? Sorry, 95 to 100. Are you clear till here? This is part of your costing paper in the next year, so you don't have to worry too much about it. I'm trying to explain. If you understand, good, or else they're not going to be asking you anything right now. You can test it in the next level. Clear? Now see here, guys, I put 100 liters. My normal loss was what? 5 liters, but I got an output of only 92 liters. How much was the industry expected loss? 5 liters. How much is the loss I got? 8 kgs, right? Out of 8 kgs, 5 kgs was normal loss. 5 kgs was what? Sorry, liters, no. Out of 8 liters, 5 liters was normal loss. This 3 liters, what is there? We call it as abnormal loss. When I'm trying to calculate cost per unit, I will still do 9,500 divided by 95 and not 92. This is what I meant, that I shall only record for the normal loss, not for this additional 3 liters loss. How do we do it? What will happen and all? We'll see later. You don't have to understand. Only thing for you guys to remember is abnormal losses are not part of cost of inventory. Are you clear till here? We will come back to the normal loss and an abnormal loss a little later. Are you clear till here? Is everyone fine? Second, storage cost. Storage cost are not considered as part of inventory cost. Third one, administrative cost. What is the third cost? Administrative cost. Fourth one, selling and distribution costs. Selling and distribution cost. Fifth one, financial charges, or we call it as interest. Done till here? So which are the 5 costs which we not take under valuation? When I say cost element, which are the 5 costs I don't take? Abnormal, storage, administration, selling and distribution, interest and financial. Please remember this. This is base for your entire costing of your inventories. Clear? So this one, are you guys clear now? This definition? We'll come back a little earlier. What did we say? Inventories are to be valued at cost or net realizable value, whichever is lower. What do you mean by net realizable value? What do you mean by? What do you mean by net realizable value?
Value at which market is ready to buy.
Net realizable value means the price which you will get by selling in ordinary course. What is that? The estimated selling price in ordinary course of business, not in exceptional cases, like just the way you run your business. If you are selling that raw materials or finished goods, how much will you be getting it? Are you clear? Now guys, there is something which you need to reduce from it. See here, what is that we will be reducing it is, see, when I'm trying to sell goods, right, will I incur cost of selling it? Now let me take an example of work in progress. What do you mean by work in progress? What do you mean by work in progress? Not yet finished, right? Can a work in progress have a selling price? Can a work in progress have a selling price? Let's say the chair was half done. You're trying to make a golden chair, but chair is half done. Can it have a selling price? Now, what I try when I say net realizable value, what I mean is, I assume that this chair is completely done and it can be sold. Please listen to it. I'm assuming what? This chair is completely done and it can be sold. I take that selling price. Assuming that the chair is completed and can be sold, I'll take that selling price. Now, let's say I'm done with 70% of the chair. Do I have to incur some cost of completing it? So from the selling price, what I do is less cost of completion. This is applicable only in case of work in progress. For finished goods, this will not come. And also, whether it is a work in progress or a finished goods, don't you have to incur cost for making a sale? Like cost of advertising or cost of brokerage or anything. So even that sale price, that cost of selling has to be reduced. So net realizable value is, in a layman term, simple thing. Selling price minus cost of making a sale. Are you all clear till here? Guys, are you clear till here? Write down the last one. This one they've asked once in 3-4 attempts, a theoretical question. The next topic, inventory record system. Under inventory record system, we have two things. One called as periodic inventory system. The other one known as perpetual inventory system. First one is known as what? Periodic. Second one, perpetual. Guys, done? What are the two kinds of maintaining inventory? Periodic and in. Okay, you need to understand what do you mean by periodic. Periodic inventory system. When I say periodic inventory system, what we do is we find out how much inventory is there. We find out what? How much inventory is there by doing a physical count. What do? We literally go and count every single item which is there in my stock. Are you clear? So we go to our godown or warehouse on a particular date and find out the value of inventory as on a particular date. Physical counting of goods on a particular date, we call it as what? Periodic inventory system. Are you clear? Easy? Now, see here, as per periodic inventory system, what we do is we find our COGS. What is COGS? Cost of goods sold. Opening stock. How do I know my opening stock? Because of last year counting. So I already know my opening stock value. I will also know the purchases value. Why? Because I would have the documents of the goods purchased. Less closing stock. This I do it by physical count. So opening stock, because of the last year's closing stock value, I know what it is. Plus purchases minus closing stock is done through what? Physical good. What is the statement known as? Opening stock plus purchase minus closing stock? Cost of goods sold. This is how we calculate it here. Are you clear? Done? Now the next one, the second method is known as what? Perpetual inventory system. Okay. Now what happens in a perpetual inventory system is we have a method of recording inventory. What happens is in this system, whenever you receive goods, you record it. Whenever you issue goods, you record it. So you are recording both receipts as well as issue. The moment you are doing the receipts and issues, don't you think you'll automatically get the balancing figure? That balancing figure is known as my closing inventory. Are you clear? So under the perpetual inventory system, what we do is we have a book. Please remember this. We have a system. This system will record the opening stock, opening stock, receipts and issues. Automatically, I will get to know my closing stock. Okay. This closing stock, I will physically verify. So there are two things which are happening. One is what? Books, where I'm counting my opening. See here, I already have an opening stock. All the receipts what I get, I record it. Whenever I issue, I also record it. Automatically, I'll get to know the closing stock. This closing stock, I will physically verify. This method of recording inventory system or maintaining inventory system, we call it as perpetual inventory system. So here I am maintaining two things. Both physical check I will do, but major emphasis is on the what? On the record system. Are you clear till here? One of the important things for your exam, you have to read it from the study material, is difference between both the methods. Done? You have to read this, and if you have still some confusion with whatever I've explained, you can bring it to the next class.